So now we have an overview of the hydrogen market, which will be provided by Martin Tengler, the head of hydrogen research at Bloomberg New Energy Finance. Thank you very much, and apologies for missing that bit.
Thank you so much. So when I was preparing this presentation, I actually had no idea how much of what I'm going to say will already have been said by the time I get to stage. So I apologize if I'm saying some things that have already been said, but maybe that just shows the atmosphere in the room. If you could please show the slides, wonderful. So 3 years ago, my colleague Meredith Annex, back then the head of hydrogen research at BloombergNEF, the job that I do right now, said at our summit in London that hydrogen is beginning to resemble the Gartner hype cycle curve. At that time, it was headed towards the first inflection point on that curve, which is a peak of inflated expectations, as we have heard today earlier. That can be told from the data. In 2022, Europe alone committed $70 billion of funding to clean, mostly green hydrogen. In 2022, President Biden signed the Inflation Reduction Act with the hydrogen tax credits. In 2022 and 2023, globally, we saw countries commit more than $100 billion to hydrogen. And developers followed the money. In 2023 alone, we saw 85 million tons of clean hydrogen capacity announced, which would be enough to displace almost all of the gray hydrogen that we produce today. And that was just announced in just 1 year in 2023. So clearly the expectations were very high, and one could say somewhat inflated. And so it was only natural, as my colleague Meredith said those 3 years ago, that the market would have to, at some point, come to a realization and start heading downwards in terms of those expectations towards the second inflection point on this curve, which is the trough of disillusionment. And again, the data tells the story for us. The funding announced so far this year, this is granted end of April data, has been much lower than in years past. So has the project volume that has been announced by developers. This is data as of beginning of September. And the gulf that we see between the production capacity for electrolyzers on one end and the demand for those electrolyzers on the other, particularly in some places like China, is becoming so big that we think it's only a matter of time until we start seeing some sort of consolidation in the electrolyzer market, most likely starting in China. Policies that have been announced are yet to be clarified, like the US IRA credits. And of course, with the US now, there is a lot of uncertainty what's going to happen going forward. And in markets where there is supposed certainty on policies that we have, like the RFNBO rules here, there are some calls to calling these policies into question. For example, Robert Habeck's letter to the European Commission. So when we read all of this news, look at all of this data, it really is no wonder when you open the internet that every day you open the news and some kind of a project gets canceled. So there's a lot of cancellations, as somebody said on stage before me. We see two challenges that are causing this, and I think people have said that before me as well. High costs, green hydrogen being very expensive, and low demand. Because it's expensive, why would somebody want to buy it? So starting with those costs, and looking at green hydrogen and electrolyzers in particular, the cost of electrolyzers have not only not fallen, as many forecasters and industry people, including my own BloombergNEF, have forecasted, they have actually gone up when we look at the results of our 2022 electrolyzer price survey and compare those to the results that we published at the end of 2022. So we saw about a 50% increase in the latest survey published in 2024 to about $2,500 per kilowatt benchmark price for electrolysis systems installed in Europe and in the West, PEM and alkaline. And even in China, the prices are much lower, $600, but still went up quite significantly. Now, part of the reason for the price increase, the cost increase, is simple inflation, which has impacted not just hydrogen, but many other sectors like renewables. But a bigger reason is that developers and forecasters are beginning to appreciate that electrolyzer projects are much more than just the stack and the purification unit, the gas liquid separation unit. There are many other components. If you're connected to the grid, you need to have power cables, transformers, nitrogen supply, demineralized water, cooling, compression, storage, and lots of indirect costs are also involved in hydrogen projects like EPC management. So all of that combined means costs are higher than people have thought in the past. The good news is that we think these costs can come down. This is our latest forecast from about a month ago. By 2050, we expect costs in the West could come down by about 50%. In China, they could also come down by about 50%. But that's a lot less than what we have expected previously. Previously, we used to say that the West could catch up with China. We now no longer think so. Now, there's one important assumption behind this chart, which is that trade in electrolyzers remains free, which, as we have seen with the recent example of the second hydrogen bank auction, might not necessarily be true, and there might be some limitations on using electrolyzers from outside of Europe. So we've come up with a second scenario, which goes to the other extreme, which is very unlikely to happen, where there's no trade in electrolyzers allowed at all. And in that scenario, we have a decline that's much smoother, not a 50% cut, but more of a 25% cut by the year 2050. And we think this is an important thing for regulators to acknowledge and to think about when they decide how important is national security and how much of hydrogen demand in the end, because hydrogen becomes more expensive as a result, how much hydrogen demand are they willing to sacrifice in the name of national security? We don't have the answer at BNEF, but we think it's an important question to be explicitly asking in policy discussions. One more question is, will limiting Chinese electrolyzers bring opportunities for electrolyzers from other countries, like India, where we are seeing early signs that electrolyzer costs could be about $1,000 per kilowatt or so, which is a bit more expensive than in China, but still a lot less than what we see here. So are we going to see more restrictions on India, or are we not? It's a really important question. So that was the CapEx, the buying of an electrolyzer. And now let's talk about the operations of that electrolyzer with electricity, of course. And we've already heard today that it's very hard to secure grid connections and that building renewables on site is also difficult. What we have assumed in most of our modeling is that developers build renewables on site because in general that tends to be cheaper than securing a PPA, which on average in our database suggests the costs are about twice as much as developing renewables on site. So PPAs can be quite expensive, but for practical reasons, it might be necessary to simply sign a PPA and source your electricity through the grid. Which, if you do that, you also need to pay grid fees, and those can be quite high as well. So that's the turquoise part of that pie chart, sorry for the small letters. The result is that levelized costs of hydrogen in Europe, green hydrogen, are significantly higher than what many have expected just a couple of years ago. And that leads to challenge number 2, which is if hydrogen is expensive, it's hard to justify buying it. So this is data from our hydrogen offtake database, where we track more than 60 million metric tons worth of clean hydrogen, most of it green, that developers want to build by the year 2030. And of that, only about 12% have identified an offtaker. Now, identifying an offtaker does not necessarily mean that that offtake is guaranteed. Out of those 12%, only about 11% is binding offtake. So that's 12% times 11%, 1% of all the projects that have been announced to come online to 2030 have secured an offtaker. So that's where the cancellations are coming from. Now, that's a lot of bad news, but I think there is good news as well. There are signs, and they've been said as well on stage before me, that we are headed, or we might be headed, towards the slope of enlightenment, which is the third part of this Gartner hype cycle curve, where we emerge from the depression and get onto some productive work. Why do we think that? FIDs have been mentioned today. We noticed a quadrupling in FIDs in 2023 for electrolyzers in Europe. And we've already noticed a 50% increase on top of that as of September 2024. And there's still some 4 months to go, which means we might see a lot more than what we have on this chart. Another piece of good news here in Europe is that Europe, in our view, is the biggest supporter of clean hydrogen, green hydrogen in the world, as President von der Leyen has also mentioned. Now, it might not appear like that from this chart where the US is on top, but that assumes that every project that has been announced in the US gets built, which they won't, and receives $3 per kilogram, which they also probably won't, especially now. The other thing that Europe has, and that really is a superpower, I would say, are quotas, binding quotas for using hydrogen. We count about 2 million tons in 2030 of green hydrogen demand from those binding quotas, and 4 million tons or so in 2035. The only other country with quotas right now is South Korea, and those quotas are not necessarily for green, not even for blue, sometimes they are for gray hydrogen. And all of this is beginning to show in our databases. So our offtake database is showing that almost half of all the binding offtake, so the serious binding offtake that we see in Europe, that we see in the world, is coming from the European Union. And we think that is partly a result of the policies I've just talked about. All of which means that we think it's actually quite possible that the EU might be able to meet the lower end of the RED III quotas with about 2.4 million metric tons of green hydrogen demand in 2030 in our forecast. Of course, that assumes policy remains as is, we don't reopen any discussions, and we don't get into stuck in loops like they say did in the US. Now, not all member states are going to be able to meet their quotas. Where I come from the eastern part of the European Union, it might be much harder to meet them, but states from the west might be able to make up for that with some surpluses. And if there is some trade allowed in between, we might be able to see even some of those eastern members meet those quotas, which might well be dependent on midstream infrastructure. The final piece of the puzzle, one more power that Europe has, is carbon pricing. Because quotas, they raise demand for sure, but the only way to raise demand long-term and sustainably is to make green hydrogen economically competitive with fossil fuels or with fossil-based alternatives. And the way to do that is through carbon pricing. Europe has some of the highest carbon prices in the world. The challenge with the carbon pricing system right now is that the same industries that might want to adopt the largest volumes of green hydrogen are also the same industries that are receiving the largest number of allowances for free. And therefore, in practice, for example, ammonia producers have paid virtually zero carbon price in 2023, and the same is likely to be true in 2024. The good news, as everybody knows in this room, the carbon border adjustment mechanism kicks in 2026, and that's going to lead to a gradual phase-out of those free allowances by 2034. Those should get completely removed, and there should be some incentives to hopefully economically adopt some green. And I know that's a controversial thing to say at a renewable hydrogen conference, but also some blue hydrogen and blue ammonia in particular from the US, assuming that the 45Q credit continues. We think there is openings for United States exporters of blue ammonia into Europe. I'm almost at the end of my presentation, and I think I have a lot of positive news about Europe. The European Union is the only market with a nearly complete legislative framework for renewable hydrogen. We have definitions, we have production infrastructure and demand incentives. And these are beginning to show in tangible ways. We have 2 million tons, almost 2 million tons, almost 12 gigawatts of green hydrogen and electrolyzers funded, almost 4,000 kilometers of pipelines funded, and those 2 to 4 million metric tons of demand secured through those quotas that I talked about. There are still some questions that need to be answered. What's going to be the role of low-carbon hydrogen? Are there going to be any subsidies for that, etc.? I know not a popular thing in this room, but an important one to discuss. Are there going to be more domestic content rules? What about those Indian manufacturers? Are we going to continue for further European auctions to limit companies from China, etc.? Very important discussion to have. Are we going to see some EU-wide financing mechanisms for infrastructure? And also, are we going to see some loopholes being exploited in the RED III quotas and other quotas that the EU has set up, which could in turn lead to actually the demand being lower than that? I can tell you the part of the world I come from, eastern part of the EU, every company is thinking, how can we avoid meeting these quotas legally? Everybody's thinking about that. So this is my last slide, and I think we've established that the hydrogen industry has been on a roller coaster these past couple of years, and this year that roller coaster has been headed down very, very fast. But I think I've also shown that there are some good signs that we are emerging onto that slope of enlightenment, and that plateau of productivity, which is the final part of this Gartner curve, might not be as far as it seems. Thank you.